Hello viewers, in our session today we shall be discussing the audit of trading transactions. We have already discussed the vouching aspect related to various balance sheet and profit and loss account items. Now let us discuss the general considerations related to the audit of trading transactions. The first aspect which needs the consideration of auditor is the correctness of bookkeeping record. The auditor should verify that the amount of profit has not been overstated, example by inflation of sales or understatement of purchases. The figure of profit can also be inflated by failure to provide for losses and depreciation. In such cases, the final accounts would not disclose a true and fair view of the business. Similarly, the auditor should also verify that profit is not understated. In case of companies, there is a specific restraint in this regard contained in Part 3 of Schedule 6 to the Companies Act 1956. It prescribes that a provision which is in excess of the amount considered reasonable by directors must be treated as a reserve. In consequence, any provision of bad debt, depreciation, expenses or liabilities which is in excess of the sum considered reasonable must be treated as a reserve. So, whatever is concerning the present financial year should be credited or debited into the profit and loss account, and the entries should be cross checked with regard to reasonability and logic. Nothing excessive should be credited or debited so that the information which is contained in the financial statement is true and fair. The second aspect which needs consideration is the observance of the accounting principles. The auditor should ensure that distinction between the revenue and capital is kept in mind while recording transactions so that profit or loss and assets stated are fair and true. For example, if an amount representing the installation of cost of machine is treated as expense, profit and value of the machine would be understated. All the amounts which have been incurred to bring the asset into the present working condition should be capitalized, but the regular and routine expenditures for the maintenance of the assets should be charged to the revenue, and those expenditure which are of capital nature should be added to the cost of the asset. Depreciation would then be charged to the whole of the cost, that is the purchase cost plus cost incurred for the erection of that asset. But all the expenditures which have been incurred to keep and maintain that asset will be charged to the revenue account. It should also be ensured that if the benefit of an expense is not fully realized within that period, it would be proper to carry forward the appropriate portion of expense in the books. Depreciation to fixed assets and provisions, if any, to the current assets should be provided to show the correct value of assets in the balance sheet. Also, fictitious assets like worthless patents or trademarks should be written off at the earliest. Many a times the companies have incurred huge costs for acquisition of patents and trademarks, but after they have outlived their useful period, they need to be written off within the next 4 to 5 years. It has been provided in the Schedule 6 of the Companies Act 1956 that all the expenditure which has been incurred for the acquisition of patents, copyrights, etc. should be written off in a matter of 3 to 4 years. Preferably 25% should be written off every year. Appropriateness and consistency of the verification and valuation basis and methods of stock in trade are of great significance to obtain a true and fair view of the accounts. It is the duty of the auditor to verify that there has been a loss or leakage of goods in the process of trading. He should therefore reconcile the closing stock with the opening stock after taking into account the quantities of goods purchased and sold. If there is any discrepancy, he must locate the cause thereof. As is well known, the closing stock of the previous year becomes the opening stock of this year. Hence, both the balances should be cross-verified by the auditor with having regard previous year amounts of the closing stock Also, he should see that the closing stock of this year is arrived at by adding purchases and deducting thereof any sales which have been made. Now, some of the factors which give rise to discrepancy in stock. These are inclusion in closing stock, the goods that have been returned to suppliers, or non-inclusion of goods returned by customers. Inclusion in closing stock, goods received for sale on approval or on consignment basis, or conversely non-inclusion of goods sent out for sale on approval or on consignment basis. To arrive at a summation of both these points, it means that whatever belongs to the entity only should be included in the stock. If there has been any sale which has been made, it should not be counted in the closing stock. The profit element should be added to it and it should be clubbed with the sales. Similarly, if there has been any returns regarding the sales, they should be a part of the closing stock, and hence the profit element should be minus or deduct from there. The next one is the failure to adjust the stock lost by fire or given away as samples. Failure to include goods purchased that were in transit at the close of the year, or to exclude goods which had been sold but not delivered. Non-adjustment of losses in weight of material in the process. So, these are other instances in which they can affect the value of the closing stock and the opening stock of the next year. If there have been any free samples, then they shall not be included in the closing stock, nor it will be there as sales, but it shall be deducted from the purchases itself and shown in the balance sheet. Now, the checking of stock and record. It is necessary to check entries of purchases and sales in the financial books. Corresponding entries in the stock accounts should also be checked. In a large concern, volume are large and variety of stocks. It is practicable for the auditor to only test check the stock entries. Where there are only a few transactions of buying and purchasing and much volume of business is not there, the auditor can thoroughly examine all the transactions that have occurred within the financial year. But in a large concern where there are too many transactions and the stock is also voluminous, it is not feasible for him to exhaustively check all the entries. So, he can test check it on sample basis and arrive at a fair judgment whether there has been a proper internal control with regard to the keeping of the stock and entry of it in the accounts books. In case there is no mistakes which are found, he can accept the correctness of entries not checked, provided there exists an efficient system of internal control. He must, however, reconcile the quantities of goods purchased and sold with the balance at the close of the year. Now, let us discuss the aspect of internal control with respect to the trading transaction. The function of auditing is to see that the internal controls are in place and to ensure that there is no leakage, prices are normal and they are duly accounted. Buying should be function independent of receiving storage, receiving and dispatching. A separate list of suppliers and manufacturers of various commodities should be maintained by buying department. A standardized form for purchase request should be prepared in quadruplicate. Now, these are the few aspects which should be present in all kinds of internal control that has been adopted by the entity. Now, the function of the auditor is that the internal control is present, it commensurates and it's compatible to the size of the business entity and is operational, and it is also functional with the daily transactions that occur in the business entity. He should see that there is no leakage, the prices entered are normal and there are no discrepancies which are material in nature. Also, he should see that the buying, selling and recording, storage and receiving and dispatch all these functions are segregated so that no one person has control over all these transactions, and this will reduce the chances of frauds also in the organization. Now the next topic is the internal control for the receipt of goods. How this will be done? Firstly, it should be seen that the receiving department should verify all the receipts as to the quality and quantity with a copy from the purchase order, transmitting the material in the stock department along with a copy of the GR note. Next, one has to see that the stock department should accept goods after getting a clearance from the inspection department. Whenever any goods are ordered, they should be ordered after a request from the material department has been made to the purchase department. The purchase department then sends the purchase order to the accounts department. Account department has a list of all the suppliers, and after going through the price list which is submitted by the suppliers, it arrives at the supplier who shall be providing those goods. These goods are then dispatched from the supplier and then they are received into the entity. When they are received into the entity, there is a check post at the entrance, and a good received note is made at the entrance. This good received note is an internal evidence that the goods have been received into the entity. The next form of check is when it goes into the material department and lies there in a packed state. After the voucher has been received from the supplier, it is cross-checked again with the accounts department whether the same quality and quantity has been received. After it is okayed, then the bundles of the goods are opened up and they are entered in the bins. So this kind of internal control should be prevalent in the entity, and the auditor should satisfy himself that there is no discrepancy in recording of these transactions. The internal control for the storage of goods. Indent should be sent to the purchase department once the quantity reaches the ordering level mentioned in bin stock card. Goods should be stored in a manner that goods are easily accessible, occupy minimum space, do not suffer deterioration, and fast moving are segregated from the slow moving goods. It should also be ensured that the goods are adequately insured. And this is really necessary that all the goods that have been received into the entity, they go into the godown or the storage or warehouse, and they are then kept in proper bins, proper places. There is segregation between the slow, fast moving goods, so that those which are slow moving should be kept at a farther place rather than the ones which will be fast moving, because the consumption of the fast moving goods will be more. Secondly, it should also be seen that they are easily accessible. The numbers, the quantity and the names of the goods are entered into the bin card. The reorder level, the stock level and the ordered quantity is entered into the bin card, and also it should be seen that there is a proper review and stock taking at proper intervals. Then is the internal control for the issuance of the goods. All deliveries from sales godown should be made on delivery note authorized by the sales department. The requisition slip should be prepared in quadruplicate. Stock department should make an entry in the stock card on releasing the good. So basically it is the onus or the responsibility to maintain the internal control for the issuance of the goods lies on the stock department, which receives the goods and also issues it. Hence, all the entries with regard to receiving and issuance should be entered into the stock register and also separately at the go down in the bin cards which are attached to the goods. Now let us take up the audit of the purchases. Credit purchases should be verified with reference to the supplier's note. The date falls within the accounting year. This aspect should also be checked. Thirdly, the supplier's account has been credited with the full amount on the invoice. Invoice is signed by the accountant and storekeeper indicating that delivery has been taken by him. Payment, if made, has been authorized. For controlling purchase expenses, it is essential that these have been classified. Hence, in all the purchases which have been done by the purchase department, the credit purchases should be entered fully with the amount being charged to the supplier. Also, it should be seen that the date is falling within the accounting year and it does not fall before or after the accounting year, because then it will either be a prior period item or it shall be an item falling out of the financial year. Also, the supplier's account should be credited with the full amount of the invoice. An invoice should be signed by the accountant and storekeeper indicating that the delivery has been actually taken by him. So, this will give an authorization also that the purchases which have been brought into the record are duly accounted for. The next one is the special precautions in verification of the purchase invoices. When invoices run into several pages, it should be confirmed that amounts relating to different parts have been adjusted together. In case goods purchased for use of officer but invoice made in the name of company for discounts, it should be verified that the cost is charged to the person concerned. Authorized sanction for purchase of goods from allied and associated concerns should also be mentioned. It should also be traced into the stock record for purchase of goods during the opening and closing months. Now, these special precautions are taken so that the business house has not been charged at the expense of its own employees. In case the trade discounts which accrue to the entity, the benefit of that is being taken by any of the staff or the officers, then the cost at least should be charged to the officer. The entity should not bear it. Only the benefit of this discount can be taken up by the staff or the employee of the company. The next aspect which needs the consideration of the auditor is knowing about the items which can increase or decrease the gross profit. Firstly, we shall be doing the elements or factors which increase the gross profit. Undervaluing of the opening stock or overvaluing of the closing stock. The second one is the alteration of the basis of valuation of closing stock. Increasing the value of some of the items included in the opening stock. Entry of fictitious purchases to boost up the profits. No provision or under provision in the expenses account included in the trading account. Now, all these items will boost up the gross profit and hence they are going to show an imaginary inflated image of the gross profit. Now, let us discuss the factors that decreases the gross profit. Firstly is the overvaluation of the opening stock or undervaluing the closing stock. Alteration of the basis of valuation of closing stock. Inclusion in the year of goods purchased in previous year. Reversal of the fictitious sale entries recorded in the previous year. Purchase returns. All the entries should be verified by reference to the record kept in the store records. The next aspect is the original invoices, which should also be referred. The large purchase returns at the beginning or the close of the year might indicate that they are fictitious. Whenever the quantity and quality of the goods received into the entity are not according to their specification, they are returned back to the supplier. Now, this is called as the purchase returns. Hence, all the appropriate records with the entity, this purchase return should be deducted so that a true and fair view of the purchases can be represented in the profit and loss account, because if the purchase returns have not been entered, there will be the overcharging of the purchases and hence the profit shown shall be reduced. The next aspect is the sales. The credit sales should be verified with reference to the copy of invoices. It should be seen that the date falls within the accounting period, the sale price has been correctly arrived at, the amount of invoice has been adjusted in appropriate account, and for internal control it is essential that these have been classified. All the credit sales should be verified because the money has not been received and only the credit note has been made in that record. Also, it should be seen that all these credit sales fall within accounting period. If the credit sales do not pertain to this year, they should not be entered, because then it is going to unduly inflate the gross profit. The next aspect which requires the auditor's consideration is the goods which have been sent out on approval basis or sale or return basis, as they are popularly called. The auditor should refer to the memorandum to confirm that it is appropriately accounted. Goods of which period of approval has already expired at the close of the year have been received back, or the customer's accounts have been debited. Goods of which the period of approval has not expired at the close of the year have been included in the closing stock. It should be seen by the auditor that the goods which have been given away as goods sent on sales on approval, whenever the credit period has not expired, it should be included in the closing stock, and if the credit period has expired and the party has agreed to keep the goods with them, it should be included in the sales and the profit element should be realized. With this, we are concluding our today's session. In our session, we had discussed about the audit of trading transaction. Also, we discussed about the various aspects related to the audit of the stock records, maintenance of the stock records, purchases, purchase returns, sales and sales returns. I hope you enjoyed the session. Thank you so much.